Thank you for joining Market News with Rodney Lake. This is a regular program for the GW Investment Institute, where we talk about timely market topics. I'm Rodney Lake, the director of the GW Investment Institute. Let's get started. Welcome back to Market News with Rodney Lake. I'm your host, Rodney Lake. Today, we're coming to you from the George Washington University School of Business, Duquesne Hall, Duquesne Family Studio. This is a George Washington University Investment Institute podcast. Remember, investment disclaimer here, not investment advice or disclaimer generally speaking. This is entertainment, educational purposes only up front. Today, we're going to cover a single company, so we're not going to do a broad-based setup, but we're going to go over one single company. We're going to use the GW Investment Institute framework, business management, price, valuation, and balance sheet to evaluate that as we typically do. So buckle up here. This company is in the energy business, and the company is Constellation Energy, ticker CEG. All right, so let's dive into the company. You might have heard about this. You would say that, okay, this is the biggest renewable play out there. A lot of nuclear here, carbon-free, as people call it, and sustainable solutions for the business. A lot of nuclear. That's it, and it's mostly merchant versus regulated. So meaning that they sell to the highest bidder. It's not a regulated. Most of the power that they produce is not regulated. So what's been sort of the push for this? Well, as we've been talking about before, AI continues to be on high demand here. And if you listen to Jensen Huang recently talked about what's the choke point here for the business, it is energy production. So Constellation here, carbon-free, that part of the market, plus high demand, plus merchant power. This is at the center of that, but it's been a very volatile ride here. Let's talk about the company. All right. So let's dive into some stats here on the company. What does this company look like from the standpoint of market cap? And again, energy producer. So utility, a little bit divergence from, we do a lot of tech companies here, sometimes retail, but a little bit different. Power company, power producer, a lot of nuclear power. One of the largest fleets in the U.S. and certainly one of the largest dedicated merchant fleets in the U.S. The market cap here, so divergence from some of our super large companies that are in the trillions of dollars. This one is sub 100 billion. You would say, well, that's a small company, still a large company. Market cap, $93 billion. This is as of towards the end of May here in 2026. All right, so why Constellation? Well, Constellation has been, and we've owned this company in the past. Why Constellation? Well, Constellation is a company that lots of people talk about, at the center of this AI revolution. They're going to be bringing back, for example, the Reactor 1, which is in 3 Mile Island, with a deal with Microsoft as an example, but they own lots of nuclear operations across the country and others as well. But in the carbon-free world, very good there. And so people would say, okay, well, this is a great, and we own this company currently. We've owned it and we still own it in a couple of our portfolios. So it's been an interesting company, and certainly it's been up and down also. But let's talk about the business. And so they are merchant power producers, so they're subject, obviously, to the whims of the market. And right now, everybody has been saying, well, this is a great place to be in. And we'll get into the sales numbers. But again, lots of power generation, 21 nuclear reactors across 12 different facilities. This is obviously a fantastic place to be right now with this tailwind coming in. And pricing power, obviously, it's a commodity product, but it's in super high demand. And you talk about Jensen Huang saying, okay, the choke point here is on the power side. So very good there. All right, so what are we going to give it? Before we get there, let's get into the sales for the company. All right, so let's dive in. You look back, let's tackle this fiscal year here. Last year is a 12/31. So if you look at that, it's $25 billion in revenue, and the trailing 12 months 29. So it's a year over year. That's a big jump, but year to year from 24 to 25, not a huge jump. But the trailing 12 months has been a jump. And remember, we care about what's happening in the future, which we'll talk about in a second, but let's go over where it's been. So in 2022, at $24 billion, and 23, basically the same, a little bit higher, 2%. You're talking, and then dive down to $23 billion, 5, so minus in that category. And then, back up a little bit, basically the same from 24, and then jump from 20 to 25 here. In the trailing 12 months, 26 to 29 billion. Excuse me, I'm a little bit all over the place if you didn't follow that. But pretty modest growth until recently. Now, why recently? You think about that. So, and let's talk about where the company is going. So, what's the mode that everybody's in? AI. We need more power. We need more data centers, and obviously to power those things, you need electricity. So, the 12/31/2026 full number, $31 billion. So that's a 23% increase, and then 2027 dropping to 7% growth, $33 billion. So the variable growth rates, not super high, certainly not in the same category as our tech companies. And remember, we can own anything. We don't have to own anything in our portfolios at the GW Investment Institute. But our students, this one found a way to some of our portfolios. We certainly have utilities as part of our energy and utility sector for our two fundamental funds. So this would be a natural idea for somebody to have. Now, this, again, varies differently than some of the tech companies we talk about. This is high CapEx. So Broadcom, which we recently talked about, low CapEx, light, CapEx light model. This is a heavy CapEx burden here. You're buying nuclear fleets. And so they recently acquired Calpine set of assets. So, and we'll talk about the balance sheet when we get to that. So, is this a good business? Is this a great business? I would think at the moment, given what's happening in the world, you'd probably call this a good business. We're giving an 8.3. We're fine-tuning some of these scores here. 8.3 for the business. It's good. I wouldn't call it great, but it's okay, and I would put it in the good category. And again, I think you really have to consider, well, where's this going? And let's uncover a little bit of that 8.3 here. So on the gross margins, not bad right now. So you're talking for the trailing 12 months through 3/31, 44% gross margins. And if you look over the years, that's been improving. And so if you look at the 2022, you're at about 30% gross margins, 35 in 23, 51 in 24, 42 down in 25. And then the trailing 12 months, 44 projected is 46 for the full year 2026. That's a 12/31 for their fiscal year. And then, so you're thinking, okay, that's not bad. So for the gross margins, 44% going out to 2027. So again, this is not bad. These are good, rather, gross margins, not elite Broadcom, NVIDIA that we talked about, Visa, certainly a different type of business. But, for a very capital-intensive business, these are pretty good gross margins. Now, again, you're having this huge tailwind of AI build out and AI infrastructure. So now let's look at the net margins here. So you go down to the net margins, this is where it looks like utility business. And so when you look at the trailing 12 months, 10%. The full year 25, 11%. Full year 24, 11%. Full year 23, 6.8. Full year 24, negative. All right, or 22, negative. All right, so obviously we care about where things are going. Where are they now? Where are they going? That's what we care about. All right, so if you look at where are they going, 13.1% for the full year of this year, 12/31/2026, and 14% for the 12/31/2027. Again, these are okay, and you could probably press that score down. We gave it an 8.3. This is okay. All right, so now let's look at the cash that you need to run this business. 3.4 in CapEx here for trailing 12 months, and the expected, 4.4 for the full year, generating 3.9 is expected free cash flow. So again, heavy CapEx burden, not great as far as where we would like to be with respect to free cash flow generation as compared to some of these other companies. And so this is not this is not the high cash flow business that Google's going to be or that NVIDIA is going to be. So not bad, and again, let's go out to the next year. What we care about, $4.1 billion for 12/31/2027. So these are good numbers. These are not great numbers. And so 8.3 seems like a fair to, giving it actually a lot of credit for being at the center of this AI build out, demand for power, demand for clean energy on that, given its composition of its fleet. A lot of nuclear, and so carbon-free, as the market likes to call it right now. So it's in a very good position. So let's see what happens there. And they've been effective at this. So now, again, we gave that an 8.3. Let's move on to the management here. So management's done a relatively good job. Joseph Dominguez is doing I think, a very good job of positioning the company for what's happening. He's been there, not forever, but certainly has done a nice job. Coming up on 5 years here as CEO. Now, it's been a compilation of assets along the way. Baltimore Gas and Electric is the history. It's based in Baltimore, Maryland. This nuclear fleet that it has. Calvert Cliffs, one of the big facilities in Maryland, and 3 Mile Island, bringing that back on, doing some innovative deals with Microsoft to buy that purchase power. They have this purchase power agreement with them. Again, this is mostly not regulated utility. This is mostly merchant, meaning that they sell into the PJM, for example. And so when the prices go up, they benefit from that. And so if you feel like, well, this is supply demand. So when you look at supply demand for power, obviously you don't create a power plant overnight. It does take time. It takes time to permit. It takes time to build. Certainly on the nuclear side, it takes years and years, and there's a real scarcity value, let's say, on that those assets for the nuclear, and they generate lots of baseload power, which is fantastic. And so I think that's where you can give the business a little bit more credit on that. And management has done a good job of putting these assets together. They bought the Calpine portfolio, and you could say, well, maybe they overpaid. But right now, they've put themselves in a good position to succeed, and they're in a position to succeed. Now, some of that depends on, is the AI build-out going to continue at the pace that everyone thinks? Well, I think that's obviously anyone's guess. And for the way that everyone's positioning their portfolios on the AI front, having power as part of that is an interesting way to play it from that point of view. And if you listen to Jensen Huang recently talking that power is going to be one of the things that is in the scarcity category and people are going to need to solve for, we need something like 1,000 times more power. Now, the natural question then is, well, how much of that's going to get built on the ground versus how much of that ends up in space? And you have the data centers in space. Couldn't resist going to another episode without mentioning the data centers in space. So I think it is an interesting challenge for that. Now, does one win versus the other, or does it take some time? I think there's, at least as an analyst, some room to think about, well, in the short and medium terms, both of these, and maybe that's 1, 3, 5 years, how do you get from one to the next? It's probably not going to be a switch where it goes from one to the other overnight. Now, if you need 1,000 times more power, probably you're going to need a different setup. Are you going to be able to build 1,000 times more power infrastructure on the ground? Probably not. Probably that's going to have to go to space where you have 24/7 sunlight, and you're going to have to manage those data centers in space if you're going to really talk about 1,000x. And so 2 orders of magnitude, that's a very different setup. Now, how does it happen between now and then? A lot of demand for the assets on the ground. And if you have a merchant setup portfolio like Constellation does, if you have a carbon-free, mostly, a lot of nuclear, baseload, consistent generation like Constellation, then you're well positioned, let's say, over the next 1 to 3, 5 years, as even if, let's say, that transition happens, well, it's going to take some time. So this portfolio of assets is well positioned. So you can give credit to the current management team for doing a good job of setting that up. And so do we know? Obviously, nobody knows what the future holds, but the current management team has put a good compilation of assets together. And Dominguez has done a reasonably good job of shepherding the company along and doing, I think, a reasonably good job of that. So what are we going to give that? We gave 8.3 to the business, 8.2 to the management. So good, maybe not great category. Now, let's jump into the price versus the valuation. Now, this is, we're going to ding them here. This has not been a good setup. So if you look at the price versus the valuation, 22 times doesn't sound crazy, but certainly for a utility company with, good, I would say, gross margins, but, okay, what you would call, these utility net margins. And so if you look at the forward PE, well, depending on where you're going, you're still above its peer category. So you probably ding it there. Earnings yield, low, you ding it there. Depending on what you're thinking for the guide forward, the earnings, okay. And so obviously you're getting a premium right now for this collection of assets. And so we're definitely gonna, I think, need to ding the valuation and bring that down. I would say 6.2 here on the valuation side. And so for this mix of utility assets, we already gave it credit in the business. We already gave it credit for the management team for putting these together, for getting the Calpine acquisition done, for owning these assets with this tailwind. So they got credit in the business. They got credit in the management, 8.3, 8.2 respectively. On the valuation side, you could say they've paid up for this in a variety of different categories, and the market is appreciating that really well. So if you, again, look at the forward PE versus peers, that's at a premium. So 23 to 24 times versus, let's say, 15 times versus its peers. On the forward side, 24 doesn't sound crazy, for example, compared to, a large tech company. But for a utility company that's heavy on the CapEx side, these are large numbers. So an earnings yield low, about 3.8%. So this is not, when you talk about a utility, you were thinking, okay, what's earnings yield for this? Steady cash flow. Again, this is the idea behind Constellation is more about what's in the AI play and what's happening moving forward. So if you're really thinking about where the company is positioned right now, I would say on the valuation side, again, we gave it credit, 8.3, 8.2 for business, for management, respectively. We're giving it a 6.2 now on the valuation for those areas that we talked about. So, okay, not great. And certainly you would call that, probably you would put that in the below average category at a 6.2. All right, so let's move on to the balance sheet, and then we'll pull everything together there at the end. All right, so on the balance sheet side, this is okay. Credit rating here, this is a utility company. We don't usually talk about credit ratings, but it's a utility company, so they carry debt. They have a lot of assets. The credit rating here, BBB1 and BBB plus, you'd probably put that as a 7.0. Interest rate coverage, 7.5 times. We definitely would love to have a better setup than that. We like to be closer to 10. The post-Calpine debt to equity, 145%. That's not great on the performance side. So you'd probably ding that at a 5.8. Altman Z-score here, you're talking about a 6.2. This is not great. Liquidity cash, 3.6. Free cash flow improving, 7.2. So if you put all that together, that's a 6.8. That is an okay setup, not a great setup. That is an okay setup, so 6.8. So, all right. Let's pull all those together. So again, we're giving it lots of credit. CEG is the ticker, Constellation, on the business side for being in the right spot at the right time with a great collection of assets. That's an 8.3 for the business. The management, great job, Dominguez, for putting this together in team, giving them credit again for being in the right place at the right time, putting these assets together, 8.2. On the price versus valuation, again, as we talked about, okay there. Again, the high forward PE compared to peers is tough, and low earnings yield, 6.2. And on the balance sheet, 6.8. Again, below average. We would like to see better metrics here. The post-Calpine acquisition obviously boosts up the debt to equity ratio. The credit rating is okay. Interest coverage is okay. We'd like to see that better. 6.8 there. So when you pull all that together, that's a 7.4 for Constellation. Again, non-investment advice. Seek investment counsel if you need it professionally. But if you're an investor, business person, analyst, I also encourage you to be checking out what's happening in the power business, what's happening in this world, because as Jensen Huang mentioned, you need 1,000 times more power. So understanding who are the players in there, what's happening in that space, I think is very important. So check out CEG on your own as well. Put some comments there. We'd love for you to come back and watch the next episode. But that's it for this episode of Market News with Rodney Lake. Thank you. Disclaimer, the content shared in the GW Investment Institute podcast is for informational and educational purposes only and should not be considered investment advice. The opinions expressed in this podcast are those of the host and guest and do not necessarily reflect the views of the GW Investment Institute or the George Washington University. Listeners should not act upon the information provided without seeking professional advice from a qualified financial advisor. Investing involves risks, including the loss of principal. The GW Investment Institute, the George Washington University, and the podcast hosts do not assume any responsibility for any investment decisions made based on the content of this podcast. Always conduct your own research and consult with a financial advisor before making any investment decisions.